Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for February 9th, 2023. It's great having you with me here today. And today we're going to talk about the European CPI and the claims number we got this morning. First, on the European CPI numbers, actually, we see the market, the yields dropping throughout Europe. The sense, if you look at Germany, came in 9.2, still clearly elevated, but down from December. So January a little better. Remember, we're starting to get the implementation of the energy controls that is actually lowering the cost for the consumer, and then that's being passed through. So helpful. We continue to get more readings as we move into this year where the consumers in Germany will be helped. So that's going to be a catalyst, probably giving some hope to the ECB, still raising rates, still talking up tightening concerns about inflation. And clearly at 9.2%, that's an elevated rate and way ahead of where we are here in the United States. In France, we saw the wage number. This is for the fourth quarter coming in lower, 0.5% roughly versus 1% in the previous. So again, that's giving a sign wages, the thought that how tight labor markets increase wages pass through to inflation as companies need to pass along their cost increases. That's a little bit easier too. So maybe a sense out of Europe. And I think this is a theme we have to watch as we move forward is the improvement in Europe may be more than the improvement we see in the United States, clearly with the base level starting much higher, but that expectation, and I think we're starting to see it in the export numbers here in the United States, and I think that's giving us a sense and maybe a little bit of a catalyst here that we need. Claims number came in moving a little bit higher, historically low. Initial jobless claims coming in a little bit under 200,000 and under 1.7 million for continuing claims. What's worthy to note here is 2 points that happened before the pandemic are starting to emerge again. One, a differentiation between non-seasonally adjusted and seasonally adjusted. What that's telling us is that the adjustments that were made clearly because of the data being kind of odd, always a little odd with claims numbers, particularly as we match up what would be the right seasonal adjustment to them. So net initial jobless claims are around 230,000 in non-seasonally adjusted and coming in around 2 million in a non-seasonally adjusted continuing claims. And then when you put the non-seasonal numbers, and this is what we get out of the different states, we see California coming in at a quarter of the initial claims and coming in at 20% of continuing claims. This has been a consistent number before the pandemic. So that's just different states have different rules and different accounting and different benefits. And some of them, like Pennsylvania is another state that has an unusually high number of initial claims versus what you would expect based on its population. Net, the labor market still seems to be very solid, and we're getting good numbers in terms of people being absorbed into the labor market. These are just marginal increases or a little bit loftier levels, but very much in line with what we have seen in terms of solid employment and market. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.